Hi, I'm Mike Larson from Money and Markets TV. There comes a time when you just can't go back to the well anymore. When people echo the words of Howard Beale from the movie Network and say, "I'm mad as hell and I'm not going to take this anymore." From my perspective, Europe has just reached that point. Look at Greece. It managed to wrangle a second €109 billion rescue program out of its neighbors in July. But now that plan is in serious jeopardy because of opposition from Finland of all places. Finland is on the hook for less than 2% of the money for the bailout, but it's saying it won't contribute even that amount unless it gets Greek national assets as collateral. And anti-bailout fever isn't restricted to Finland. Citizens of Austria and Germany are also getting fed up with the constant demands for more money from their profligate neighbors. And I haven't even mentioned another key threat. The bailout is contingent on 90% of Greek bond investors agreeing to a debt swap to lower the country's financing costs. But participation is reportedly much lower. That could cause the deal to fall apart and put other bailout programs for Portugal and Ireland at risk. And then there's this issue of Eurobonds, one of the last best hopes for a pan-European solution to the credit crisis. These bonds would put the balance sheet of every single Eurozone country at risk to support the weaker PIGS countries. Now, advocates believe these Eurobonds will break the back of the debt crisis once and for all. But Germany's having none of it. Chancellor Angela Merkel insisted she won't be blackmailed into backing Eurobonds. And the Germans have every reason to be worried. If they put their balance sheet at risk just to support countries like Greece and Ireland, it could drive German borrowing costs up by 47 billion euros, according to the IFO Institute for Economic Research in Munich. Opposition from other countries like Austria and France is also running high, making the Eurobond idea look downright dead on arrival to me. That means a simmering crisis could explode again at virtually any moment, sending the euro currency and European bank stocks sharply lower. Now you might argue that global financial stocks have rallied recently, and Warren Buffett just threw $5 billion at the struggling Bank of America. Two Greek banks also just agreed to merge in an attempt to stanch the bleeding. So why aren't I more optimistic? Because each and every step along the way, European officials have treated the issue like a liquidity crisis, but it's actually a solvency problem. Banks simply do not have enough capital to absorb the losses on all the European bonds they're loaded down with. Outright failures or dilutive capital raises are inevitable. And Christine Lagarde, the managing director of the International Monetary Fund, agrees with me. She just told policymakers gathered in Jackson Hole, Wyoming, that the need to recapitalize is urgent, and that if it doesn't happen, quote, "we could easily see the further spread of economic weakness to core countries, or even a debilitating liquidity crisis," end quote. So my advice remains the same. Don't listen to Wall Street's siren song. Pare back your risk, limit your exposure to financial stocks, use rallies to lighten up on equities, and also to add investments like inverse ETFs that will make you money when the next leg down gets underway. For Money and Markets TV, I'm Mike Larson. Thanks for watching, and happy Labor Day.